Good afternoon, everybody. It is Monday, September 26th, 2022, and the market opened a little bit up today, and that didn't last very long. I would like to talk about what the Fed is doing and where I think they're really going. I'm going to talk to you about some things that we've already brought to the forefront a year ago. Our forecast for this year has been spot on. I think that there will be a tremendous stock market rally going into the presidential cycle, which is fairly typical, and I think is going to happen again. So let's take a look at what the Federal Reserve is really doing. Back in May, they told us that they would be raising interest rates and taking money off the Federal Reserve balance sheet. They're doing it. The stock market doesn't like it. For months, market participants believed that the Fed would crack and give free money back to the traders and everybody else who was speculatively bidding asset prices up. Chairman Powell slipped a little bit in July and gave them some hope, and we got that rally. In September, the chairman didn't slip. He was very hawkish a week ago, and the stock market is starting to believe him to the point where they have a lot of money on the sidelines, and we'll get to that in a second. But a year ago, I told you this, that the Federal Reserve is reloading its bazooka for the next time. And we can already see the next time on the horizon because leading economic indicators, which we covered last week, are all turning over. Inflation is coming down rapidly. As I said in the spring, it would by the end of the year. In the fourth quarter, you're going to see blowout sales. And I don't mean the absolute level of sales. I mean sale prices across the retail industry. You should be able to buy holiday presents this year very cheaply. How do I know that this is what they're doing? Because it's what they always do. If you're a student of history of the Fed, then you know that they manipulate the cycles. And you also know that they manipulate the dollar and that they do a lot of it for geopolitical reasons. I tried to convince you for months and months that inflation was due to energy prices primarily, and then the breakdown in supply chains, which stems all the way back to 2017 when we decided to have a trade war with China. COVID was an event that gave OPEC and China and Russia the ability to manipulate the entire global economy. It's not something that they can do forever because ultimately the United States, North America as a bloc, and Asia have far more power than three countries, Saudi Arabia, Russia, and China. But because we are dependent on fossil fuels right now, which is already flattening out that dependence, all the numbers say so, within a couple of years, by 2026, 27, which I've pointed to for 2.5 years now, by 2026 and 2027, as EVs and clean energy start to flood the market, the power of Saudi Arabia and Russia will be gone. What is going on right now is a last-ditch effort on their part to make as much money as they can. And I'm sure Vladimir Putin knows that once he's gone, Russia finds its way back to the West anyway. We need to have enough respect for what other people are doing to not dismiss everybody as crazy. Saudi Arabia knows that the end of the oil age is upon us, and they're trying to make as much money as they can while they can. They manipulated oil prices to do it. Russia wanted a land bridge through what is now Ukraine to Crimea that would last forever. And once Putin is gone, one of two things happens. Either they become friendly with the West again and work things out, and Russia comes roaring back economically, or Putin's gone and they turn hard right, which we discussed before, and things get worse. And then you end up with a nation that's big and powerful and acting like North Korea. Not something anybody wants to see, except some hardcore right-wingers. And the problem is that hardcore right-wingers, cyclically, every few generations, roughly every fourth generation, gain power because transition scares people and racial diversity scares people because it must be those other people that did things wrong and screwed everything up. It must be those people coming over the border who screwed up America. I laugh about it because historically, it just keeps repeating itself. It's their fault. And usually when the message is it's their fault, is one, there's usually not much wrong to begin with. And two, it's not their fault if there is. Historically, over and over and over again, it's really never been the immigrants' fault. And I'm talking about immigration because I think there's an important point to be made here. Going back to the Fed, though, they're reloading their bazooka. Tom Lee, Will Grumman, TD Ameritrade, they're all starting to say the same thing. is that we are flirting with breaking things, but it probably won't happen. So when the doomsayers are out there, they're casting a very wide blanket, because if you say everything's going to hell, more people believe it. And they start squirreling away an awful lot of cash that they can spend later. If you took a look at Bloomberg this weekend, you saw this article. For the first time in a very, very long time, I'm in the camp where I think the money on the sideline matters. And I've got an article that needs 2 more paragraphs that basically says that the TINA trade is broken for now, that the bond market is going to soak up a lot of the cash that's out there, because when interest rates peak sometime in the next several months, there will be another rally in bonds. And people who can collect 3 to 5% on bonds, many of them municipals, which are tax-free, are also going to get some capital gains over the next few years. And we'll probably see interest rates low again into the next recession, but even coming out, as we have to support the baby boomers. There really is no plausible way for interest rates to stay very high. And if we forget that slow growth is forever, then we're just choosing to listen to traders' narratives. Demographics are destiny. And in the future, demographics and robots will be destiny. There is nothing terribly wrong with the world today, other than we have some bad actors manipulating the system as we try to transition away from fossil fuels. And as we try to put the screws to China for reasons that probably aren't very legitimate, but recognize that we do need more secure supply chains. And in a world where machine learning and automation can do a lot of the things that labor can do or did going forward, we don't need to have those supply chains overseas to save money anymore, because a robot here or a robot there costs the same. And if you can cut out the transportation expense, why wouldn't you do that? So the age of growing globalization in manufacturing is in fact probably dead. The age of globalization of finance is still growing, and consumers and travel will continue to occur all over the world. People will continue to consume. People will continue to travel. Money will keep moving. Technology can be anywhere. People who work in technology can almost be anywhere. People in finance, as I am proving, can be almost anywhere. Many, many services can be from anywhere. So globalization from the standpoint of manufacturing may be dead or dying, or at least sideways. All the other forms of globalization continue, especially when you think about the way communication works. So with Saudi Arabia and Russia and China manipulating the global system right now, knowing that there's an end game just a few years away, as EVs and alternative energy just continue to take share, that power goes away. So we are at a spot right now where theoretically it could be more likely that we have a war. Given that war can be so painful, and given that the West has been able to help Ukraine kick the shit out of the Russians in Ukraine, it's probably pretty unlikely that we go down the wartime path again. Putin is losing. There is a rumor that President Xi got overthrown this weekend, which seems to have just been a bunch of Chinese and Indians picking on the guy, which was in the end pretty funny. Tens of thousands of people saying that Xi was overthrown and on house arrest. Did you see that on Twitter? That doesn't mean it won't happen either. And I think it means very possibly that Xi does not get a third term. What does that mean? What does it mean if there's a snapback going on from these far-right ideologies, that the majority of people who are not far-right are finally starting to say enough of this shit? I think that's what's happening. I think the red wave in American elections won't happen in November. In fact, I think the Democrats hold the Senate. Not so sure about the House. And I think things are going to keep getting better the way they have since the Dark Ages. And as these supply chains move, because the fourth industrial revolution makes it pretty easy for that to happen, there's just a time lag for getting things accomplished. And people look backwards a year and they look at right now, but they don't look forward 5 years. They're going to miss a lot of opportunities. There is a mountain of cash waiting to get reinvested. The biggest mountain of cash ever. And right now, there's an awful lot of money flowing into U.S. Treasuries, which is allowing the Fed to not have to be the buyer. So with the rest of the world buying U.S. Treasuries, allowing us to shrink the Fed balance sheet, which again, I don't think matters all that much, there's a huge inflow of money coming to the United States again. What have I told you about the dollar over and over and over and over? It is going to be the reserve currency of the world for a very long time. There really is no alternative to the dollar. That is the real TINA trade. Doesn't mean that you can't trade the dollar in its channel, but the new channel is higher. than it was before. And we've covered that over and over again. And I fear that a lot of people have fear about buying into the stock market between now and the end of the year. And if you do, you need to go back and read some of the things I've said over the last year and a half, 2 years, 3 years. Because with the exception of the time frames involved, everything has been right. Everything. I went back and read 50 of my articles over the last couple of weeks, at least 50. And with the exception of the exact quarter-to-quarter time frames, everything was within a year or two. I said oil prices would go up to 80 when they were 40 and 50. They went up to 80, and then they fell back because of COVID. They spiked, which I said would happen. I told people to buy futures, not USO. Didn't know which oil companies would do well. Pioneer and Occidental were the two that I suggested, as if you had to have them, or Total. They've all done okay. Occidental will get bought out by Berkshire Hathaway. It's not because of the oil. If you believe the idiots who say it's because of the oil, then you're just not freaking paying attention. It's because of the carbon capture and the natural gas. And the fact that Occidental and Chevron and Pioneer and a couple other companies have huge conventional reserves. That means cheap. It means no input cost. It means they can just ride out that cash flow while they get into other businesses like carbon capture and natural gas, which don't require fracking, which is still expensive. It's not the frackers who are going to lead us on this energy transition. It is the conventional producers. It's the wells that just keep on tripping out oil without a lot of capital input. And as solar grows at 30+% per year, and EV growth is similar, gasoline cars go kaput, you're going to see over the next 5 years, the energy transition be something that if you haven't invested in on these pullbacks, you're going to go, gosh, I wish somebody would have told me. All these things move together. But the trader narratives are simplistic and very often based on just the whole, how far can we push fear and how far can we push greed to make our trades work? And a lot of them have that Austrian economist tilt because Austrian economics is way easier to deal with than Keynesian economics, even though Keynesian economics have proven to be right for almost a century now. And really even before they were called Keynesian economics. The business cycle in most of the world does ebb and flow. But for the leader of the global economy, which happens to be the United States, and I think broader will become all of North America in the next generation, it is in fact different because you have the global reserve currency, because you have the strongest per capita economy for the big economies anyway. Nobody can touch the United States. We have the resources, we have the security, money, technology, labor, pretty soon more robots, and hopefully more immigrants to fix the tiny, tiny problems that we have. Remember, I've told you over and over again, where's money made? Where? Where's money made? Where is it really made? Money is made at what? The margins, exactly. Glad that some of the folks can post that. Money is made at the margins. If you take a look at the leading economic indicators, again, which we looked at last week, what do you see? Everything's turning over. We're headed towards a recession. What kind of recession? Will it be going to hell? Or will it be a short, shallow 2-quarter recession? Or potentially a skip straight recession where you get a couple of bad quarters, but they're separated? Now, I actually think that we might actually see back-to-back quarters that are negative. We'll see how much pickup there is at the end of the first quarter from what could be a pretty bad fourth quarter. And knowing that the first quarter is usually the slow quarter. We'll see. We are now in the first bond bear market since World War II ended. Right there. Bonds are down more than 20%. First time since the end of World War II. What does that tell you? Well, look, right? Big bull market after that. Secular bull market. Lasted 40 years. Got a little bit of a reset. Lasted 40 more years, but actually less scale. What's going to happen to bonds in the not too distant future? Bond rates are going to peak, and then they're going to turn over. Who's telling us that besides me? The Federal Reserve is telling you that. Look, they are projecting that through 2023 and 2024, the interest rate will come down on the Fed funds rate. They are just reloading their bazooka as fast as they can to get the impact that they want, which is all of the leading indicators, which includes the stock market and the bond market and the real estate market, to reset asset prices. They just want everything to get cheaper for a little while. Sometime next year, equity prices will turn up and so will bond prices. Real estate prices probably are weak for a while longer. And something you have to remember about real estate prices. As the boomers really start to die, the oldest boomers already starting to fall off, oldest and unhealthiest. We are going to go from a housing shortage, which is really only there because of so many Airbnb houses. That's not even a joke. Between the Airbnb houses and the couple percent that are owned by institutional investors now, that's the margin. And as I've said, what if there's some regulation on that in the not too distant future? We can go from a shortage of houses to a surplus of houses very quickly if we regulate. And as the boomers die, if we don't replace them with immigrants, there's going to be a lot of softness in real estate for an extended period of time, like 20 years. The big bull markets in real estate, I believe, are probably over. The big money in real estate, which is typically, this is where it's been, has been in redevelopment. And the redevelopment of the future in real estate, which I am acutely interested in, which I am very interested in, you know that's what I look at for my real estate projects. I have another big meeting coming up in a couple of weeks with some developers, is sustainable development. Parking structures with solar power, buildings that don't have natural gas and have their own microgrid, walkable areas. We got these big stupid malls. What would be the smartest thing to do with these malls? Those end cap stores, the ones that they can't fill anymore with a Macy's or a Sears or a Kohl's. Why not put an athletic club there and some work from near home offices, then attach a condo building or an apartment building? Why not do that? Well, as it turns out, that's what's happening. There just aren't any shortages, folks. People want to talk about shortages. They are a blip in time. Go back and look at some stock market charts where the big crashes are. Now, if we take a look at the stock market, what does that look like to you? Even the big crashes aren't that big. They don't last that long. So as this stock market turns over, and maybe for a hot minute, we get back to 2016 prices, which I don't think is going to happen, but it could. Do you think this area here around 300, 320 on the S&P 500 or on SPY, 3,000 to 3,200 on the S&P 500? It's probably still pretty likely. And it's more likely now than it was before the Fed got super hawkish. So here you go. First wave, bear market rally. Second wave, will that be the end of it? Or do we get the extra set of waves and one more level lower? So if you're an Elliott wave person, you'd expect this market to bottom out in here, unless you think that it's, the extended where you get one more up and one more down. Could be either one. Who's going to decide? It's going to be the Fed that decides. Or there's going to be some sort of international event that causes one more leg down. We are very, very close to wanting to buy some stocks, right? Another 10 to 15, maybe 20% lower on the broad index in the S&P 500. That means that the zombie companies are coming down. And the zombie hunting has begun. The great divergence that I've talked about is happening. The small caps and the mid caps are already pretty attractive. And we just need for people's S&P 500 funds, they get beat up, so they panic sell. There's a little bit of residual into the small and mid caps, but a lot of them are, look at the volumes. There's nobody left to sell a lot of them. And that's why I can start buying them, keep buying them. We are near the end of the bear market. I don't know if it'll end in October or November or December. I don't know if there is a rebound rally and then one more leg down next year. And anybody who tells you that they know is lying to you or is a bullshit artist, or both. I guess if they're lying to you, they're a bullshit artist. But if you haven't been buying our small and mid caps, I'll tell you for the last time, I'm not going to say it anymore. You better buy them now for the next month, 2, 3. You start scaling in, because those companies, those fourth industrial revolution companies, those clean tech companies, clean energy companies, decarbonization companies that are built on the back of all the new things that we're changing the economy to, are going to crush the Procter & Gamble's of the world and all the other consumer staples companies that were out there and that actually made money for a while, because the world doesn't really need them anymore. If you're not on the train of decarbonization, then you're just not paying attention. That's where all the big money is going. And the big institutional money is telling you what's going to happen next. If you fight it because of ideology or stubbornness, well, that's not what I'm familiar with, get familiar with it. You get rid of the ideology and get rid of the stubbornness, because the opportunity that's right in front of you, if you invest in the right half of the stock market, or 60% or whatever it'll be, is so huge that the difference between doing that and investing in the whole thing or investing in the old man stocks, it's going to be 3, 4, 5x. It's going to be just amazingly different what you can make investing in the fourth industrial revolution and decarbonization, and some good consumer stuff versus banks or consumer staples, utilities even. And you really have to pick and choose. Utilities are a great spot to figure out where the winners and losers are. You take a look at Next Era Energy, right? We've looked at that chart before. Is that the symbol? Yeah, take a look at that. And then you take a look at XLU. Right. Take a look at XLU. Let's just get rid of all the drawings. I'll draw them new. Take a look. New style utility, the basket. That means there's a lot of utilities down in here. Go to all. So about 2001. There you go. Utilities moving towards clean energy, old utilities. This is the great divergence. We could do the same thing with Tesla, let's say, right? There's both fourth industrial revolution and clean energy, and compare it to XLI. Whoops, compare it to XLI. The XLI hasn't done bad. And we'll throw a SPY in here too, just so you can see. Let's do the last 5 years. There you go. There. How's that? So XLI and SPY actually kind of move in tandem. And this is what Tesla did. Now, is Tesla going to come all the way back to here? Yeah, maybe. It has to converge with companies like Ford. Ford will go up. Tesla will come down to meet it. Or maybe Tesla chops and Ford keeps going up. Or GM. This is the great divergence. These are the companies we have to find. I'm not saying it's Tesla anymore. But we have to find the companies, if this were today, which companies are going to do that, are going to separate themselves out. And it's going to be the small and mid-sized companies with advantages and a leanness to them, the ability to increase margins as their revenue goes up, to capitalize on economies of scale rather than having to deal with the fat of a bloated large corporation. They're going to do the best. So let's look at one more thing. Bill Ackman made a comment. It should sound a lot like me. Inflation can be mitigated by reducing demand or increasing the supply. I've been telling you that for a long time. The Federal Reserve knows this. They can't kill the development of supply chains, nor can they kill the development of clean energy and, in the short term, American production of energy on the oil and gas side. So there is a limit to what the Fed can do in flattening out demand. And those lines have to converge. Supply and energy have to converge with demand. And if you lower demand, you risk lowering supply. So all the Fed can really hope to do is flatten out demand for a short period of time so that supply chains and energy production can catch up, which won't take long. We're already a couple years into the move on those things. 3-4 years from now, we're going to be talking about deflation again. 5 years on the long side. But 3 to 5 years from now, we'll be talking about deflation again. Why? Because there will be more than enough supply again. And there'll be more than enough cheap energy again. What's happening right now with all these negative trader narratives, it's just another blip that they seek to exploit. One of the things that Ackman talks about is, smart immigration policy could really fix, one of the tertiary issues, which is wages and labor, right? Wages going up too fast in certain spots and not enough labor in other spots. Why aren't we using our immigration policy to bring in everything that we need? More labor on the low end, more labor on the high end. Those are 2 spots. In the middle, we don't need. Plenty of people in America can do the work in the middle, plug and play stuff. But there's a lot of grunt work that Americans don't want to do, and that'll be solved by immigration and robots. And there's certain work at the high end that we just don't, we have a shortage of engineers and doctors and things like that, people like that. So why not accept a whole bunch of Russians and Ukrainians and Mexicans and Central Americans and South Americans? Why wouldn't we do that? Now, if you're far right-wing white wacko, you start to say, well, they're trying to replace us and turn us brown. Kiss my ass. There are easy solutions to every problem out there. And Churchill is right. America always gets it right after they try everything else. That's the path that we're on. That's the path that we're always on, that we've never deviated from, even though, we decide to run into brick walls from time to time. It's going to happen again. And sometime in the next few months, interest rates will stop going up. We'll get our mini recession, and then this stock market's going to come out screaming. And in fact, the stock market will start moving up as it anticipates what's going to happen next, a month or 2 out, and then a year out, and 2 years out, and 3 years out. And the smart money is already moving in the directions that I told you to move in. Fourth industrial revolution, and decarbonization. That is where trillions of dollars are moving, and pretty soon, trillions more, right? The chasers are coming. If you get in before the chasers, they will push your stock prices up to the moon. These satellite as a service stocks that we own that are single digits right now, if you don't own those as a basket, please call me and I'll start managing your money. To me, those are some of the easiest stocks to invest in. Limited competition, government money, industrial contracts, right? I mean, everything you'd want, an oligopoly in space. Ginkgo Bioworks. Somebody's going to compete with them eventually. Between now and then, they're going to get hundreds of royalties stacked on top of each other. It's already starting. All you have to do is go and read the quarterly reports for some of these companies, and you go, wow, they're like a year or 2 or 3 away from just having money hand over fist. It's not even that hard to figure out. If you buy a basket of small and mid caps, 12 to 20 stocks, then you add your large caps on top, you're going to crush the market. You're just going to wipe it out. This is going to be one of the last times I can implore you to think this way. Because when things start to move, right, that's going to be it. We got 400 or 500 people now listening, paying for the advice. If you listened to me last November, December, January, you got heavy in cash. And you've been scaling in super slow ever since. You still sit on a bucket of cash. You're going to want to get most of that invested in the not too distant future. We had a pretty neat conversation over at Fundamental Trends. Shooter was mentioning the Kondrativ waves. Maybe that's how you say that. I started becoming aware of this stuff in the late 1990s when I read this book, The Fourth Turning, by William Strauss and Neil Hall. Now, Neil Hall does a little work with Hedgeye, so I read him from time to time still. I think Strauss is full retired. But Harry Dent, right, he's another guy. Talks about the cycles. The problem with these sorts of charts is that technology and financial engineering have changed them. Financial engineering and technology have changed these so that the peaks are still where the peaks are, but the troughs aren't as low, or the troughs are very fast. And again, what's going to happen this time is that you're going to see the zombies taken out and killed over the next 5-10 years, slowly, suddenly, back and forth, up and down, right? You won't be able to predict it. A lot of them will be event-driven, management-driven. Take a look at Kohl's department store. They have the ability to do some great things, but their management sucks. And there's local people trying to fix that. Maybe it happens, maybe it doesn't. There's been activist investors on Kohl's who took a look at the Sears model, and they wanted to do to Kohl's what was done to Sears, right? Everybody knows the story of Sears by now? No, maybe? What happened to Sears? Nobody knows what happened to Sears. Eddie Lampert got control of Sears, stripped it of its real estate assets, didn't invest anything into the store, and just sucked out billions of dollars. Killed Sears. Somebody says he raped it. Yeah, that's exactly what he did. It's exactly what he did. Can you imagine if 20 years ago, Eddie Lampert took a look at Amazon and said, hey, why don't we have Sears.com and really make it a big thing? But no, what Lampert did is he let the company go to hell. He loaned it money, got more control. Shares went to nothing. He didn't care. Because he had control of the company, he just kept stripping the assets out, selling the real estate, and made himself rich. And the activist investors who came to Kohl's were going to do the same thing. They're just going to sell off the pieces. They don't care. If Kohl's is smart, they do an inventory of all their assets, and they start developing mixed use around the spots that they can, and then sell everything else. Anything else that's not profitable. Be the way to go. They could build a Kohl's REIT. They could do it. Instead, they want to open more stores. These little small footprint stores, 500 of them they want. It's dumb. It's a really stupid idea. They could just make Kohls.com a good website, which I've been complaining to them about for a decade. It's still a crap website. Still a crappy app. They don't even have single sign-on. You gotta sign on 2 or 3 times, get into the rewards, get into your credit card. Usually you have to sign into one of them twice. Right. So Kohl's wants to do something similar to the Walmart neighborhood stores. It's a dumb idea. You're just paying rent. I can see doing kiosks inside of a building that you have apartments in, but whatever. In any case, these cycles don't operate in a single universal application anymore. Generationally, things are different now, technologically, financially. So you can have simultaneously different waves running. Old man stocks on one wave, fourth industrial revolution, and decarbonization stocks on another wave. So all these people who are like, I get my 4% dividend on Procter & Gamble or whoever. Yeah, well, until you don't. And the minute that they stop raising that dividend, the stock price is going to fall, and then they're going to cut the dividend. If you haven't seen that cycle play out over and over again with companies that lose their growth catalysts, again, I don't know what you're paying attention to. So in the very near future, we're going to want to invest a lot of money. This is the monthly charts. Look at how many are in the 30s now for RSI. They're either there or almost there for being buyable. And you've got certain companies that are hanging on to their bull markets, but not many. 4 stocks out of what I monitor that are over 70. Let's take a look at the entire Russell 1000. Almost nothing is overbought anymore. Let's make sure I'm doing this right. Yeah, there's almost nothing overbought anymore. These are large caps, Russell 1000. A lot of stuff just about ready to be bought. Look at all those 30 somethings, right? One more leg down, and you need to be a major league buyer. And if there's another leg down after that, there'll be a rally first. You can manage your risk during that. What kind of questions are there today? So, like I told you before, I have a hard time valuing Coinbase, but I like the ETF DApp, DAPP. That's where I'm buying. I just want the basket of the top dozen or so blockchain stocks. That's what DApp gives you. So if we take a look at this, pretty big correlation, right? I don't know that I need to pick out the individual stocks when DApp gives me the top dozen and the correlation is like huge. I mean, it's almost perfect correlation. So I'm just buying DApp. Yeah, so I had some DApp limit orders hit at 5, unless there's a rally between now and then. But the blockchain infrastructure that's out there, the misunderstanding is that people are saying it gets hacked. Not really. It's the companies that get hacked. They're really not stealing directly off the blockchain. And the energy industry, the financial industry, transportation, shipping, there's an awful lot of industries using blockchain internally. One of the companies in DApp is a software company that helps make that happen. What do we know about platform software companies? Google, Amazon, Microsoft, they do pretty well. So I think picking out the individual blockchain companies is difficult. I think it requires knowing an awful lot that maybe is above our pay grade. But if you buy the basket, and like I said, 12 companies make up some like 60 or 70% of this fund. You're buying a good basket that's highly correlated. If one of them sucks, it doesn't matter. 2 of them suck, it doesn't matter. If the industry just keeps growing the way that it's growing, and if Bitcoin becomes more valuable, which it seems like it will, because again, institutions and very rich families are buying it from the retail side, we are seeing some classic patterns in the economy right now and in the markets right now, where the rich people are taking advantage of the panic on the retail side. And yet Warren Buffett is a buyer. Think that through. He's finding spots to invest as retail and traders add cash. We added cash a year ago, almost 9 months ago, 8, 9, 10 months ago. So we'll be ahead because we want to get our cash invested before this group does. And then they will create the FOMO on things that we already own. And I think you're going to be amazed at how fast you double and triple your money on a lot of these positions from where you bought them, from where your net cost is. And some of them are going to go up more because these traders and the people that are holding all this cash, they ain't going out and buying Procter & Gamble. They're buying the 4th Industrial Revolution and they're buying decarbonization. All right. Have a good week. You're probably going to see some trade alerts in the not too distant future. I'd say the next 2 to 4 weeks is what I think. I don't know if we're going to hit the bottom in October, but I think it's possible. It's just a matter of, is there that fifth wave, right? Is it being a 3 wave or a 5 wave down? I'm not sure. I'm going to have to ask Shooter. One of the things that Shooter said today is there could definitely be that extra leg down. We'll see. So, all right, everybody have a good day. I'm going to stop recording, get this edited after I make a sandwich. I discovered that if you take avocados and chickpeas, a little bit of chives, which I grew this year, and mash it all up together, you can make a pretty good avocado toast. Just throwing it out there. One day we put some salmon on it. One day we put fried egg on it. So trying to go healthier. All right, everybody, have a good day and think like an opportunistic buyer, because in the next few months, that's what you need to be.